everybody. Welcome to Cigars and Syndication, where we're passionate about real estate and cigars. And today we're in for a really good treat. Jay cracked open his humidor and drug out my father 2016 limited edition Le Bijou, and it is a miraculous smoke so far. And I'd like to thank Jay for digging deep in his humidor today.
Uh, Thanks. Welcome, everybody. My name is Junaid Noor. Thank you, Robbie. I had gotten a new box of cigars and I didn't have any room in my humidor. And I was just like, what is in here? So I started digging out, and lo and behold, this box of Le Bijou limited edition, 2016 limited edition came out. It's been sitting there in my humidor since 2019. So that's why it's very strong, very full body, it's got some red pepper. I got some chocolate, and I get a little hint of like a lime or an orange, like a citrus.
That's very interesting. I'm getting a lot of the same. I'm getting a lot of the same spices. It's kind of a red pepper flake with just a hint of chocolate and sweetness. Very creamy. It's so far really good, smooth cigar. Amazing taste and smell. I can't even describe it. It's a delicious cigar so far.
So I think they only made 4,000 boxes of this limited edition, one and done. They didn't make any more. Uh, it's not easy to find, unfortunately. But if you go to cdmcigars.com, they still have some in their rare and vintage selection. So they still have some available, but it's not an easy cigar to find.
Well, and it's a Ecuadorian wrapper with Nicaraguan binder and filler, and my father knocked it off the charts with this one. Really good smoke if you get a chance to find one. Today we're gonna dig a little deeper into some underwriting. We're gonna talk about trended versus untrended in projections. And what do you think about that, Jay? And how does it affect the underwriting?
Man, I'm just enjoying my cigar right now.
It is absolutely one of the better smokes
so wonderful
that I've
smoke.
ever had.
But alas, we have to get to work. So as we do underwriting, we do a little bit of a deeper dig into underwriting. One of the things that comes up, whether you're underwriting a single family house, or if you're looking at a little bit of a larger property, maybe a 4-unit or a 6-unit rental, or a larger multifamily property. One of the things that you'll be asked to do by your lender is to forecast the rents and forecast what the income and the cash flow is going to look like. Sometimes it's 1 or 2 years if it's a smaller property. For us, when we do larger properties, it's about 5 years.
Yeah, and it's really, your approach to underwriting is always a conservative approach. And when you look at trended versus untrended, I think a conservative approach is always best. But, using trends, can make a deal look better, can make it more enticing maybe for a lender.
Yeah, so let's define what that means for our audience, right? When you use trended rents, for example, or trended expenses, that basically means that you're looking into the future and you're looking at an increase in the rents as well as the expenses. So it starts trending upwards. When we say untrended, we're basically saying that whatever the rents and the expenses are right now, everything stays flat for the next year, 2 years, 3 years, whatever the bank wants, and it doesn't change. So it stays the same, which, if you look at it from a logical perspective, it doesn't always make sense, because things go up and down. We have inflation right now. Rents are expected to go up as costs are expected to go up.
Yes, and I enjoyed that article that you just wrote on this, and it's on albanyparkcapital.com. And if you want to read that article, it really it touches on a lot of that stuff, and it has a very good understanding of how it impacts or how it relates to inflation and interest rates.
Yeah. So what happens is that when you come up with a forecast, now nobody knows the future, but we can take educated guesses, right? We know, for example, costs are going up, right? So when you're talking about a multifamily property, you have your maintenance staff, you have your leasing staff, those payroll costs are going up. In addition, we know that energy costs are going up, right? So if you're not metered separately, your electricity, your water, your gas, all these costs are increasing with inflation.
So with the interest rates rising, what do you think the lenders are looking for? Are they leaning more towards a trended or untrended?
So that's the interesting thing. And what's happening nowadays is that the lenders want you to underwrite the rents as untrended. So whatever the rents are today, let's say you have $100,000 in rental income for the month, okay, on a small property. They want you to use that $100,000 for the next 4 or 5 years, which is preposterous. But the expenses, they want you to trend up.
Right, that just seems unreasonable. It seems unreasonable on a couple levels. One being that, you know, with inflation, you would think that because of the additional cost incurred by the owners or the landlord, they would have to pass those along to the tenants.
And also because of inflation, rents will definitely go up. They have to go up because costs go up. But what lenders are thinking about, and again, lenders become overly conservative in certain times like these, and what they're thinking about is, well, rents can only go up so high before demand starts decreasing. And if demand starts decreasing or rents start going backwards, then the property won't cash flow.
With inflation and interest rates, and it's all cyclical, right? Everything is a cycle. When's the last time that you've seen rents actually go backwards? And I guess maybe we can keep it specific to the Houston market, just because that's where we're experts, more or less.
Well, there are certain cities where across the U.S. where rents are going. I won't say necessarily going backwards, but rent growth is not as high. So, for example, Austin, I know for a fact, has not had huge increases in rent. Uh, but a normal rent increase is 3 to 5% a year. Over the last 2 or 3 years, some of these cities have had like 15 and 18 and 20% rent increases. So if there's no increase this year or a 1% increase this year, you're still not that, it's on an average, it's not that bad. But banks look at things in absolute terms and, oh my God, certain cities are falling backwards. I think the national average rent has dropped by 1% over the last quarter, last few months, or since December of last year. We're in February right now. I mean, a 1% drop is not that big of a deal, especially when rents had been going up by 15 and 18% in most markets.
Yeah, but you could kind of see where a lender would get a little bit more cautious. Even take a year or 2 years ago, an aggressive lender using trended reports, if their rent's not growing at 8 or 9%, and they had a variable rate loan, and now their interest is 2 3 points higher. I mean, that could really impact what a deal looks like.
And this is one of the reasons why deals are not getting what we called in our terminology penciled in, right? That basically means that they're not hitting the return requirements for the lenders or for the investors, and so people are walking away from some of these deals because number one, your interest rates are high, your expenses are getting up, are increasing due to inflation, but then the bank won't allow you to increase the rents in a trended fashion, at least in line with, even if it's not in line with inflation, but at some conservative growth rate. Maybe, we underwrite our increases at 3% every year. That is that is not overly aggressive. That's very conservative. We may have higher increases, but 3% is pretty much what we underwrite at. And if the banks won't let you even do that, then you're not going to be able to do the deal.
Yeah, it becomes increasingly tough to find the right deal. You have to have your initial investment has to be in a really good piece of property at the right price, whether it be a raw land, whether it be a house, whether it be a value add multifamily unit. You have to find the right deal to make the numbers work.
Yeah, and the only other way to do it with increased borrowing costs and increased costs for operating costs, but you can't increase your rents. The only other way to do it is to reduce the purchase price of the property. And the problem with sellers, unless they're in a bad situation where they have to get rid of the property, they're kind of holding off. They're just like, well, last year we were getting X dollars for our property, and according to the market, prices of multifamily properties have dropped 10 to 15%. Well, you know what? I'll just wait. My property's cash flowing. There's no need to sell, and so I'll just wait. I'm not going to sell, and so the deals are getting less and less and less available.
But just like you have that case where the seller is in a position where he can hold this rising inflation, rising interest rates, it could also create some opportunities, I think. I think there's going to be some opportunities where maybe an owner didn't do the right things with his money and didn't sign the right deals. And maybe with this interest rate, it might force a sell.
Yeah, it goes back to the single family homes back in 2006, 2007. Um, what happened was that people would buy residential homes that they were living in, and they would use a variable interest rate at 2%. Well, at 2%, they have enough cash flow from their income to be able to afford that house. But when that variable interest rate reset after 3 years or 5 years, and now the interest rates are higher and it went from 2% to 6%, all of a sudden they can't afford their property. And the other problem that happened was that because residential properties are valued very differently from commercial properties, the value of the property was upside down. And so come 2008, this is what one of the big issues of the crash was, is that you had so many people with variable interest rates. When those rates reset at a higher rate, the mortgage payments were not affordable anymore, and their houses were underwater. Most of those houses were 100% loan to value, or sometimes 105% loan to value. So people just turned in their keys and walked away and said, "Hey, I don't want to live here anymore."
Yeah, I mean, I think there's people that are probably sheltered in during this time period that they don't want to invest or they're not looking for deals. But I think if you're out there and doing your due diligence and capitalizing on your networking and looking for deals, they're out there, and hopefully you can your hard work and networking will pay off and you can land a good deal.
Yeah, and there'll be some great opportunities for multifamily properties where if they had a commercial loan and the commercial loan is now recasting, what we call recasting after 5 years, where they have a balloon payment after 5 years, and usually what the bank will do is they will redo the loan at a higher interest rate, whatever the prevailing interest rate is. Well, if the property was mismanaged and it was doing well at a 3% interest rate, it was cash flowing at a 3% or barely cash flowing at a 3% rate, but there's no way it'll cash flow at the rates I'm hearing from lenders right now are 8 and 9%. It's not going to cash flow at 8 or 9%, then they're going to have to get rid of the property because they may not be able to refinance it, and they don't have the infrastructure or the management to be able to cash flow that property. Since it was barely cash flowing at 3%, they don't know what to do. They're not going to be able to do it at 9.
What impact does that have on the cap rate?
So cap rates are inverse with the property value. So as cap rates go down, values go up. As values go down, cap rates will start going up. So, in Houston last year, we were seeing 3% cap rates. That means that an investor who put in their money can expect a 3% return, basically. Um, but now those cap rates are going up. They're at 4, 4.5, I believe. They're going up to 5. Some of them are going even higher than that.
Well, how are you? I'm about through my first third here on this Le Bijou, and still getting some nice sweet chocolate, along with some good pepper. Really good creamy cigar.
No, I love this cigar. It's been aging in my humidor, and yeah, I'm getting some chocolate. The pepper's gone. It's a little bit more creamier now, and it's just a fantastic smoke.
And the amount of time that you've had this thing in the humidor in your humidor at the right humidity level, it just makes it all that much more enjoyable.
Oh, it's a very strong cigar right now.
Well, Jay, I'm glad we took a little deeper dive into the underwriting, and I hope we continue to do that a little bit at a time, because it's actually overwhelming to look at the underwriting on some of these deals. And I hope that the trended versus untrended really helps people understand where the lender's mindset might be, and maybe how to put their own deals together so that they're still attractive to the investors and the lenders.
Yeah, no, I'm glad we did this. A lot of people had been asking for a little bit more clarification, and we'll continue to do some more deeper dives into underwriting as we go along. We have a lot of articles. An article on untrended versus trended rents is we're going to be posting that on albanyparkcapital.com. Hit the resources tab, and there's a lot of articles there. And we hope you learn something from it. We hope that you enjoy a Le Bijou if you can find one.
Check us out on YouTube or any of our social media. Leave some comments, but most of all, take time to enjoy a good smoke and educate yourself in real estate and be passionate.
And cigars.
And cigars.
Thank you.